Well, welcome everybody. I'm joined here by Ken Cavola and Hugh McManus. Cy Lynch is on a mission trip for church, so he can't be here today. My name is Mark Robertson, and again, welcome to the December session of the Roundtable on behalf of the Better Investing Mid-Michigan chapter and Manifest Investing. And we basically started things off with a cover slide with a nice picture of the fireplace. That's kind of the way we feel, kind of warm and fuzzy, and you'll see why in just a few minutes. Let me go ahead and get some of the other stuff out of the way. Ken, are we actually showing the display okay at this point?
I'm seeing the disclaimer really nicely.
Okay, let's go ahead and dig into the meat of everything then. Especially if you're new here, no investment recommendation whatsoever is intended by what we do. This is all about education and demonstration. We may actually hold shares that we talk about here today. And again, just keep in mind that this is for education and demonstration. Here's a quick look at the agenda. Again, welcome to the session. We're going to talk a little bit about what we're trying to do here. I'm getting a little feedback from Natalie. Ken?
She's in the background. I'll mute myself, Mark. Go on.
Okay. All right, so again, what we do here, we'll go into that a little bit. We'll talk a little bit about the scoreboard. We do want to celebrate a little bit. I chose the topic of just one thing to talk about for a few minutes. You see our three selections from Ken, Hugh, and myself. Mesa Labs, Staples, and Coca-Cola, and then we'll let the audience vote on those three when we get done. And as you'll see here in a minute, the audience is doing pretty well. Again, if you're joining us for the first time, extra special welcome. If you're returning, extra special welcome to you too. You know that we do this with, we're pretty serious about it. When we pick a stock, we really do have an expectation of outperformance, and everybody here knows that there are no guarantees in this business, and they don't always work out. What we are trying to do is collect a bunch of stocks, and we keep track of them one by one. But we want the overall portfolio, if we have a tracking portfolio, to generate an outperformance measured by the long-term relative return of a 5 percentage point advantage versus the Wilshire 5000. We also want to see the majority of the selections made outperform, and we'd like to see 60 to 70% of the selections that we make actually outperform the total stock market index. And again, we do use the Wilshire 5000 for that. So let's jump right into the scoreboard. How are we doing? We're pretty happy about this. As you've heard us say for many months, that sometimes it just takes time. Sometimes you have to give some of the selections time for the quality. We know that quality really acts as a buffer during bear markets, corrections, recessions, all of the above. And sometimes it just takes a little bit of nasty market timing and tough periods in the market for us to shine over the long term. We do hope to reach that line that you see up here, this 5% line. That's the objective. The other line on this chart is in a tribute, or it's kind of a nod to the performance of the average investor over the last 20 years. The average investor underperforms the total stock market by 5.3 percentage points. That's per year over the last 20 years. So this is what average people do. This is what we try to do. We'd obviously be happy with in between, but we do want to catch up to that line, and recent months have been quite favorable. Now, 3 of the 4 nights are actually have positive relative returns since we started 2.5 years ago. One of us doesn't. Well, we're not going to identify that individual because it's too painful to me. The audience is the top performing participant in this challenge. I mean, the audience relative return to date is +7. That's 7 percentage points better than the market for the audience votes that have been done over time. And you can see that we also have to smile and get a little bit warm and fuzzy about the number of stocks. Roughly 3 out of every 5 selections made have now outperformed the market over that time frame. So we think it's worthy of a cyber standing ovation and maybe a little bit of a bow and just maybe a prayer or a hope for cross fingers, whatever works for you, that we will continue to keep marching down this path, because it's a good one to be on. Here's a quick look at what have you done for me lately. These are the selections made over the last 6 months or so, and again, this is every single selection, whether it's made by one of us, by one of our guest participants, or in some cases, as in the case of Vera Bradley there at the bottom, that was an audience selection. So was Landauer. That's why you see the repeats there. Those are probably audience selections. Echo right in the middle. But what we're looking for is holdings that have actually outperformed the market since the time of selection. And what we really want is a green number in that far right-hand column. So a green relative return means that it's outperforming the market. And you can see that there's a fair amount of green there. Earlier this morning, Ken was celebrating eGov. That's the information technology company for, goes by NIC. Doing pretty well. There's a couple there that are doing pretty well. Aflac, good old Aflac since July has outperformed by 19 percentage points. Not bad. And again, most of those numbers are looking pretty good. Aflac up here also a repeat selection, doing pretty well. So overall, we're pretty happy with that. Any comments on any of those guys?
Yeah, Mark, can you maybe go a little bit more in depth about how you calculate the accuracy rating?
Yeah, all the accuracy rating is comparing the performance of the stock. So let's look at the top one in the chart. That would be Apple, selected. I don't remember who selected it, but selected back in May, on May 29th, 2012, at a price of $567.23. It's actually gone down a little bit. Everybody who knows Apple knows that it's taken a little bit of a slump. So it's actually down minus 10% during a period when the market's actually gone up 5. So it literally is, how is the stock done? Minus 10 compared to the market. So minus 10, minus 5. So the comparison would be Apple is actually 15%, 15 percentage points below the market since July. So it's actually one of the more adversely performing stocks over that time frame. So you can look across the line for any one of these. Anytime that is a positive number or showing in green over here in this relative return column, you'll see a 1 here. And that's just for counting purposes. So we were literally taking and going all the way back to July 2010 and counting them up and saying that 58.5%, basically almost 60% since July 2010 would have a 1 or have outperformed the market. So it's literally just a counting mechanism. You can see the Vera's at the bottom. The Vera's been kind of stepped on a little bit lately, but we still have very high hopes and pretty long-term expectations for Vera. Bradley. Does that help, Ken?
I think so, Mark.
Okay. These numbers that you see down here are the long-term results. And again, this is the number that we are just beaming over, the 1.3% beating the market. Take a quick look at the ones that are at the bottom of the portfolio with respect to the return forecast here. We sort by the projected annual return, the return forecast on the far right. And you can see that basically all of them are in pretty good shape. Even the ones at the bottom are pretty good holdings with some momentum. Or as he would say, Bank of America, he'd probably be tempted to even go after more because that's kind of a special situation or a turnaround from his perspective. So again, we will put some of those in the portfolio, but we don't see any automatic challenges or anything leaping off the page that or a stock that needs to be removed from the portfolio because we fear significant underperformance going forward.
Mark, we're getting one more record-keeping question from Mike, and he would like to know, how do you get the market return column? Where do those numbers come from?
The market return column would basically be a comparison of the Wilshire 5000. We actually used the Vanguard Index Fund, VTSMX, and that's the change in that value from the date of selection through whatever date that we check the returns. So we're literally just looking them up and doing a change over time.
Okay, I'm going to speak directly to Steve, who's having trouble seeing the presentation. If the slides are changing very, very slowly, Steve, it's indicating that you have a very slow internet connection. You might try closing down other functions that are working on your computer right now and devote all your computer resources to the GoToMeeting itself. Because everybody else is seeing the presentation without too many issues. Thank you.
Okay, one of the other reasons that we're not in a hurry to make any removals or challenges to the portfolio lies right here. The overall portfolio, and this counts all 50 or 60 stocks, the quality and the return forecast, the projected annual return, they're both just fine, along with the overall growth of the portfolio. So there's nothing requiring, a portfolio-driven or a portfolio-centered need here either. So that's another reason that we might be a little more prompted into taking action on one of these stocks. These are the only stocks in the portfolio that are below the average market forecast, which right now is 8.7%.
Mark, here's an interesting question from Rebecca. She says that she's in a you can never have too much manifest investing quality state of mind. She'd like to know, how much better is a 95 than a 90 or an 85 or a 65?
Well, we can certainly open this one up for debate. I think anytime you get above 80 at manifest, the numbers are basically the same. You're basically dealing with, as Ken likes to point out, an A+ on a report card. And, I don't know, if my kid brings home an A+, I don't ask them how high of an A+. A+ is, an A+. So, we're actually experimenting with a portfolio which we refer to as the Core Diem. That's COREDIEM if you want to look it up on the Manifest site, where that one is actually going to have a very high quality rating. And it's going to be interesting to see if that seems to induce or lead to a differentiated performance. I don't know, Ken, how do you feel about 82 versus 78? And Hugh also.
Yeah, well, I agree with you in almost across the board as far as this is concerned, Mark. I do distinguish between a 65 and a 90, and I think that's probably the same difference that you'd have between an A- and an A+. But when you get up into these numbers, like you're talking about at 95, 90, even 85, I think they're essentially all the same. Statistically, I'm looking at how the quality rating is derived in the first place, and to vary by 5 points, you don't need very much change in the core principles to get a variance of 5 points. So I'm going to say that if you're staying at 80 or above, you're probably in one category, and maybe 65 to 75 is that A- category, and maybe there's a few in the middle. Frankly, once I get above 65, I don't differentiate too much between the quality of the stocks I own.
That's a good question, though. Thanks for the question. We do think that obviously the difference between a 70 and a 40 is pretty substantial. And I think most of the people here would agree with that. And even in the case of what you're seeing on the screen right now, Adobe at 62.8, that's not the end of the world. I mean, they're going through some challenges right now, and some people are looking for quite a turnaround, but even that is it's a strong, good rating. I mean, it's right at that dividing line between excellent and good, so it's still up there in the top echelon of companies. Anything else on that, Ken or Hugh?
No, I'd probably just look at it as, say it's a Fahrenheit temperature and you're trying to grow tomatoes outside. What temperature do you like? Anything above 60 is good, particularly if you have a glass house.
Yes, says the guy who lives in a place where the temperature ranges between 65 and 75.
High quality.
Good stuff.
Yeah, where would you like to live?
That's right. That's a good way to put it.
Yeah.
You want to have enough of those temperature stocks, huh?
Yeah.
All right, let's move on because we're losing ground fast here. I thought what we'd do here is the three of us kind of take this subject and kick it around a little bit because I think it's an important one. And this goes back to Jack Palance and that movie with Billy Crystal a few years ago where he points out that just one thing. And recently over the last several months, there have been a number of very prominent gurus that have come out with this death of equities concept, and like it says there again. And in fact, just the day before yesterday, AP came out with this article that ordinary folks are losing faith in stocks. And part of that article actually includes a quote, and that's why I brought this one up, because I think this is crucial. And Bill Gross, who actually came out with the death of equities column a month or a month and a half ago, he actually made a clarification in that AP article where he talked about what is dying is not stocks. It's not really the potential for stocks dying, but the cult of stocks. And in fact, he goes on to make the point that if there have been excesses and abuses and stuff like that going over the last 10 to 12 years, that maybe that's the type of stuff that could start to run out of steam a little bit. So it's an important thing to latch onto as a long-term investor, that you know, the S&P 500 stocks, those large cap companies that have been kind of stuck in the mud for now over 12 years, when their return forecasts start to look pretty good, it probably is worth paying some attention to them. And I'll just close with one last thought. I mean, if you look at the world through the eyes of our community, 12 years ago, and you guys have heard me talk about this before, 12 years ago, Ralph Acampora, the renowned strategist from Prudential Securities, came to the National Convention in Detroit, and he stood there, and I'll never forget it as long as I live. He basically said, you know, there's an awful lot of people out there promoting index fund investing, you know, for retirement planning and everything else. And he basically stood there and said, I think they're going to get killed over the next 7 to 10 years. And he's, you know, he basically was saying the S&P 500 is not the place to blindly invest your money. And he stood there on that podium and said, I'm looking out over an audience of several hundred people. He says, you guys have the answer to this question. You know how to go shopping in the right areas. And he says, I envy you. You know, you won't fall into that S&P 500 trap. And by the same token, when the time comes to return to them and to pay more attention to them and to shop for them more frequently, please do that too. So I'll just kind of throw it open and ask the two guys what they think of that thing. I mean, why don't we start with you?
I love that quote. I think it's a great quote. I mean, it's almost when you start talking to people about stocks nowadays, it's like walking outside with bell-bottom pants or something. You know what I mean? It dates you immediately. But the fact is, you know, and we've seen many examples of it recently, now's a great time for buying. And I'm not a big fan of the index funds either. I mean, I've had a few discussions with people, and obviously if they're not interested in doing the grunt work anymore, perhaps that's the place to be, obviously, you know, diversify across index funds for bonds and shares of common stock, etc. But for me, it's like shopping in a supermarket, buying one of everything, putting it in a blender and drinking it, you know? An index fund, it's just not appetizing. I like to go out shopping and try to find the winners and the losers.
Absolutely.
I buy both Coke and Pepsi.
How about you, Ken? What are your thoughts on just the general topic of the loss of faith? And
well, Mark, I've for a long time I've thought and bemoaned the fact that our language has put us in a situation where we're always worried about the next crisis, and where we use very strong language to describe things that aren't really as bad as they seem, and then that doesn't leave us any kind of language to use to describe things that are truly horrendous, truly bad. And I think it has to do with stocks. I listened to pieces of this 24-hour news cycle about stocks, and everything's a crisis. Everything is making the market move, and everybody has reasons why the market goes up 15 points and goes down 50 points, and we get all these reasons and all this information, and it's all done in a voice that's louder than it should be, and they can't even wait for the other person to finish talking before they're talking at the same time, and it just makes all of this discussion less desirable. It doesn't come across as civil anymore, and a lot of it doesn't come across in my mind as being as having any basis in reality or basis in fact, when in fact I know that it is based in fact, it is based in reality, and I still believe in the fundamentals. So I guess I'm pointing my finger not necessarily at the news folks, but at everybody that wants to make everything a crisis constantly. And I think that's led to a lot of the things that take some good, strong legwork, and it's led us to a place where a lot of people don't want to do the legwork anymore. They don't want to do their homework. They're just tired of everybody shouting about it, and it's easier to escape to a good book or maybe go lie on the beach somewhere and throw your hands in the air and say, not this year. I guess that sounds kind of pessimistic, but I have to think that eventually we're going to regain our sense of balance. I hope so, at least.
I think that's a good way to put it, Ken, and I don't think it's overly pessimistic. I think, first of all, anybody who's here listening this morning is not ordinary. I would consider you extraordinary, because I know that 99% of you are willing to do a little bit of homework and audit assumptions about growth and profitability and valuation, and you get that stuff. Or if you don't get it, you dig in until you do. And there's a lot to be said for that. And the only thing that kind of concerns me, and I'm doing a lot of homework in this area, is has there been any form of structural damage to the markets that make it different this time? And I'm coming to the conclusion, maybe a little, but nothing earth-shattering. There's a lot of concern over the high-frequency trading. Even the people on the street who don't have really any idea what that all entails, it just doesn't smell right to them, and that's part of this loss of faith. So I'm not seeing structural damage, and if that's true, if we're right about that, then again, think back to any time in history, back when Hughes started getting in investing, and Ken's lived through it at least once, where, through the 70s, where people became very disinterested in stocks, happened again within the last decade, and those are times of opportunity. They always have been, and I don't see any structural reason to believe otherwise now.
Mark, we're getting some interesting comments. John is commenting that U.S. global investors indicates that Americans have missed out on about $200 billion of stock gains as they pulled money from the markets at exactly the wrong time in the past 4 years. Kay says she thinks some of the anti-stock attitude stems from the push to make employees use their 401k and 403b retirement plans, and that seems to be focused on mutual funds rather than individual stocks. Marianne and Phil are asking whether the baby boomers have made a huge difference. I know those of us that are baby boomers tend to see our generation as controlling a lot of things, but Marianne and Phil are wondering if the baby boomers moving a lot of their money from stocks to safer vehicles might be causing some of the issues as well. We also have hands in the air from Joyce and Ann. So Joyce, I'm going to unmute you. Go ahead with your comment, Joyce.
Yes, I cannot hear Hugh at all, and I wonder if there's a problem with his speakers or whatever. Microphone.
Okay, Hugh, if you can speak a little bit more loudly, that'll help.
Can you hear me now? Copyright AT&T? Seemingly not.
Ann, was that any better?
Oh, I couldn't hear you at all.
Well, let me change
That is better.
microphones and see if that helps.
I think most people are hearing him pretty well, though, and I heard him actually better that time, Ken.
Okay, and Ann, you're unmuted. Go ahead.
Well, I just wanted to say that to me, you don't really have a choice other than to be in the stocks. I mean, what else are you going to do? I mean, you're going to be in CDs? I don't think so. That's what I'm dealing with my elderly mother. So, yes, it's kind of scary sometimes to be in the stocks, but I don't see that you have a choice.
That's an excellent point. We were just talking this past weekend of sitting with my father and thinking about the difference that he's got a pretty healthy stake in Colgate-Palmolive. That is, to him, and at least to me, is not a terribly frightening position. And I mean, the dividend yield from that far outstrips. Ken, I'm getting a lot of feedback. We might have to mute.
That's coming from Hugh, maybe. So I'm going to put a mute on Hugh for a moment. Go on.
Hopefully, he's not getting crawling under his desk or whatever out there. So anyhow, I think that's what we're seeing. And as I know your style, Ann, I know you must invest in quite a few of those type of companies.
Ann, why don't you respond to Mark? I'm sorry I muted you. Go on. Some technical issues there, Mark. We also have a comment.
Can you guys hear me now?
Yes, we can, Hugh.
You can.
Yeah,
I can hear you fine.
Yeah, I tried to change mics, but it wouldn't let me, so.
Okay. I can hear you fine.
Okay.
All right, any other comments?
Yeah, we're getting a comment from Julie Werner down in Georgia. She says, ha, the death of equities via the death of interest rates, or versus the death of interest rates. She says, I'll take stocks, thank you very much. Bob Shaw makes the point that the millennial generation that's just beginning to come into the workforce, just beginning to buy homes, things like that, as they're actually a larger group than the boomer group, and they'll continue to get larger even than the boomer group as the one group shrinks in size. He says that, that as they start to buy stocks in their early 30s, that should bring some of this idea about stocks back into favor again. Mark, we have a question from Jim. He says, what's your view of the stock value prospects of domestic life insurers and annuity producers?
No, excellent question. I guess my answer would be exactly what the stock studies show. I mean, if you look back 9 or 12 months ago, they appeared to be significantly underpriced. Back when we were looking at the "What have you done for me lately" slide, we noticed that Aflac had generated the best returns over the last 6 to 7 months amongst all the stocks that we have selected. So again, it comes back. You talk about faith. Have faith in the process. Have faith in the studies. You know, obviously there's going to be bumps in the road, especially in that area of business. But take them one at a time. Figure out what your expectations are, and believe them and put some faith in them. Obviously, do the right things with prudent diversification. But again, if you've got a good, even if it's a property and casualty insurer that looks good, nothing wrong with that. I think Hugh McManus's performance here over the last several weeks is a testimony to that. That sometimes you can so-called bottom fish in some of these when they really get dramatically undervalued.
Here's another interesting question, this one from Ed Brown down in Grand Blanc. And Ed would like to know, how worried are you, Mark or Hugh? How worried are either of you about the fiscal cliff?
Well, let's let Hugh tackle that first.
I'm not overly worried about it. It certainly looks like we're going to go over it and find out that it's probably not as bad as they say. It will be fixed next year. But, you know, the fact remains that when you look at how the federal government works, it you know, people say this many times, it takes in 60 cents and spends $1, and that has to be fixed some way. And my attitude, honestly, on this one is that if you want to fix it by increasing revenues, you don't really need to have elections anymore. You can pick people from the phone book to do that, because that's an easy job. I think they have to do a hard job and figure out the thing that we all have to do, and that is to figure out a way to pay our bills without printing money. But I don't think it's going to be bad. They will fix it. They always do. The sad thing is that there's a race on at the moment between the Federal Reserve and Congress to see if it's going to be fixed by fiscal or monetary measures. And the monetary measure will be inflation, and that's not going to be nice, but there's a certain inevitability to it. There's enough liquidity out there. I jokingly say there's an enormous aquifer of liquidity somewhere that hasn't appeared yet. When it does, it will appear as inflation, and pretty hefty inflation, and global inflation. But I guess governments have the chance to avert that by using fiscal policy if they are able to do that. But I don't worry, because the thing that you always learn about investing is that every time there's a problem, it's also an opportunity. It was horrible to live through March 9th of 2009. It was a great time to buy.
Yeah, and I would just pile onto that same comment. And one of my favorite guys that I've shared with many of you is Eddie Elfenbein, Crossing Wall Street. I'm going to mention him here again in a few minutes. And he goes through a fairly elaborate analysis of the fiscal so-called cliff and points out that it really is a fiscal slope, There are no true deadline dates. All the stuff that you're hearing on TV is basically fabrication and choreography, and that's not to deny what Hugh just said. There are serious issues to be faced, and they have to be faced over time, but there really isn't this moment in time, and it's not a fixed, even if there was, it's not a fixed moment, and it's all an artificial creation and just a bunch of noise right now. And again, take advantage of it with a very long-term perspective. All right, well, Ken, I'm showing we're about halfway through.
Ken was saying.
Go ahead.
Well, I was saying that you know, I view news channels really as entertainment, because that's to some extent a large part of what they do if you really analyze the reports that you get. And much as I enjoy watching CNBC, and I really do, I've said for years that it is the financial equivalent of a pornography channel. Because it is certainly there for entertainment, and adult kind of entertainment too, but with money.
Absolutely. All right, I'm showing us about halfway through. We probably better transition into our stocks part of the program. We do appreciate all your comments. We'll probably rev up a thread revolved around this article and this faith concept on the Manifest Forum and at the blog that we'll talk about in a minute. And I would just encourage all of you to express your feelings, especially when we hear from, especially some of you that have been doing this for a little while. I'll respect your experience and perspective. And please feel free to share that, especially keep in mind, if we really do see a bunch of 20 and 30-year-olds come to this party, your voices are extremely bolstering. So keep that in mind as we go forward. All right, let's go ahead and get into the stocks part of the program. Ken has selected Mesa Labs for today, and go ahead and take it away, Ken. Ken, I think you're muted.
Oh, well, you just missed some really good stuff, guys, okay? Let's start again, okay? A lot of folks have asked me, how do I study a really small stock when I don't have reports, I don't have value lines, I don't have information from Morningstar, things like that. And my suggestion is to just read as much as you possibly can about the company. I will disclose that I recently purchased Mesa Labs after spending about 2 months in fairly deep study, not so much from the financial standpoint, not going into their balance sheets and things like that as much as I could, but trying to understand what the company does and trying to formulate an idea about whether or not there was potential for the company to do significant growth in the next 5 to 10 years, and if all of that was falling into place correctly, whether or not the valuation on the company was reasonable and could stay reasonable over that period of time and still make me some money. So you're looking at the Mesa Labs website. This is the first place I'll go for a stock when I can't find any real information from the financial standard resources. And if you just sit there and don't even touch the screen, you'll see that going by in front of your eyes are a very descriptive listing of what the company does. This company makes all kinds of tools, all kinds of precision instruments, and most of these things are used to measure different things. Now, I will be the first to admit that the data sources are having a very difficult time placing this company in an industry. Mark calls this company a medical supplies company, although he and I are debating right now whether it might not be more easily classified as a precision instrument company. Value Line calls it a diversified company. Morningstar likes to think of this company more from the point of view of medical instruments, but they're all trying to grapple with the fact that the company is really, really highly diversified, and their products are used in all kinds of different industries, from the oil and gas industry in measuring how fast oil flows through a pipeline, to measuring flow in tubes that are used in dialysis, They measure torque on bottle caps. They measure CO2 pressure inside a bottle of carbonated drink. They have things that you put into a packaging situation so that you find out the history of how cold and how hot the package was in its journey from wherever it started to wherever it ended. So when all that's put together, it's a very, very diversified company with pretty decent financials. I found investor relations after looking around for quite a bit. I had to finally go to About Us, and then after I went to About Us, and you can see my cursor is hovering on that About Us, then I had to click Corporate, and finally I came up with, if you look at the tabs atop the Corporate piece of the web page, I finally did find Investor Relations, and there was some more information. Here's where I could locate all of the actual financial forms, the 10Ks and 10Qs and the annual report, and a number of other different interesting pages at the same time. I'm going to go real quickly to my toolkit and just show you the graphs of Mesa Labs. I'm pretty happy with this company. This actually belongs to, this SSG belongs to the the Mid-Michigan Model Investment Club, and we also own this company in our portfolio. It's a little bit big for your screen, so let's cut that down so that you can actually see it. And if you'll notice, the company had a little bit of difficulty during the recession years of 2008, 2009. The growth definitely slowed. In fact, looks like earnings took a little bit of a hit during that time. But since the recession has officially ended, we have very substantial growth going on again, both in sales and in earnings. I'm very confident that the company is going to be able to maintain growth. My own estimates are growth somewhere in the 16, 17, 18% range. And the same numbers on the back are telling me that the company's been able to turn around its margins. They hit a low at the recession and right after the recession, but they're moving in the right direction again. And the same thing's true from the depths of the recession, where return on equity fell to 16.7. We're back up to about 20%, and I think we're moving in the right direction. I've estimated PEs about the same as my club going forward, although I'm a little bit more optimistic on the high side. I think this company might generate PEs, average high PEs of 23, 24, maybe even 25 going forward. I'm very comfortable with 11 or 12 at the low side. And when I put all these numbers into place, I get a par value of about 17%. If you'll notice on the par, if we compare that to manifest investing, and again, I'm trying to replicate the process that I use to actually put together an analysis of a stock. So I've gone to the website. I've looked very carefully at an SSG, and now I'm using manifest investing as well to come up with a second opinion. I'm hitting the stocks tab right here, and I'm typing in the ticker Mesa Labs, and I'm finding that Mark's par is very, very close to the par from my stock selection guide. That gives me some confidence about that. I do like to break the quality rating down. It's a very high quality rating for this company, and I like to look at the 4 components. I especially like to see that the comparison on the industry sales growth to the company sales growth and the comparison on the industry net margins to the company net margins is giving the company almost 50 quality points. And that's the maximum they can get. They're getting almost as maximum quality points on EPS stability. The only place that we're a little bit low right now is on financial strength. Remember that the financial strength number on Manifest is an amalgamation of a number of numbers coming from a number of different sources. My experience tells me that small companies tend to be rated a little bit lower than very, very large, stable blue chip companies with high-class portfolios standing behind them. The smaller companies haven't had the opportunity to demonstrate how they handle their finances, and many times what they're doing is rapidly changing as the company grows. So I'm not as concerned when the lowest quality rating is financial strength on this very small company. All in all, I don't see anything not to like in this company. I want to caution everybody, it is a very small company. It only sells, and I'm going to go back to the front here, it only sells about $10 billion a quarter. So even if I say that's 12
million, Ken.
A million, I'm sorry. Even if I only say that's 12, we're less than $50 million in sales. It's certainly growing like a small company, sales growing at about 19%, and that's a pretty decent number, even though there are certainly some cycles, and I would expect this cyclical nature to be there in this very small company. They just don't grow arrow straight. I would expect, however, as this company moves into the 80, 90, 100 million area, that these sales lines and earnings lines will begin to straighten out. I hearken back, and I think in my mind, to companies like PetSmart, companies like Neogen, companies like Quality Systems, where as they grew from very small to just good, comfortable small companies, their lines really did straighten out and show me the kind of consistency that I can use to predict the future. So I'm very confident about my analysis on the company for the moment. I will watch it much more closely than I would watch a Procter & Gamble, for example. But I'm very much sold on this company at the moment and its potential for some pretty decent growth in the next 3 to 5 years. Mark, you want to take the screen back then and go to whoever's second?
Yep, go ahead and switch it back to me. I will point out that Linda Schuler is making a comment that she also likes the fact that Mesa Labs can box up their products and send them all over the world. That's certainly a nice feature. And Dean Alden would like to know, what do you think about their purchases of other companies? Any comments on that, Ken?
Yeah, I'm noticing that they are doing acquisitions. But it's not a major strategy to grow by acquisition. It seems that when they find a small niche company that fits in the kinds of businesses that they're comfortable with, they don't have any problems buying it. Their balance sheet is certainly strong enough for them to make the purchase, but their strategy is certainly not to grow by acquisition. They have a significant portion of their resources devoted to research and development, and their strategy appears to be to grow by organic methods, and that means to create new tools. I think I neglected to mention also that the company depends a lot on creating software to interpret the data that comes from these tools that they create as well. So they not only create the tool, but then the system to help analyze the data that the tool is producing.
Okay, with that, we'll come back. There may be some other questions as we wrap up in an open Q&A at the end, but let's go ahead and shift gears to Hugh. And Hugh is he's in stubborn mode again this month. He's going back to Staples. And I think we'll encourage him to talk about, this seems to be a fairly low growth potential company. Maybe discuss some of that. And, just there's a couple slides here that give you some idea of, what the company faces. And if you could just give us a little bit of a reason why you think that, for instance, the value line forecasts are attainable. So take it away, Hugh.
I hope everyone can hear me. If you can't, just put your hand up. I've turned this microphone up about as high as it can go. So I'm hoping it's working out fine.
You're coming across fine to me, so that probably takes care of the majority.
Okay. So, you know, as I told you earlier, Mark, I was originally going to select Microsoft, but I thought it was such an obvious selection that at least 2 other people would jump on it. So maybe a lot of people said, oh no, I'm not going to touch Microsoft, somebody else is bound to have that one. But it was showing up in many different people's portfolios. A lot of people were grabbing it recently when you looked at different things on Manifest, different portfolios there. So I decided to go back to my old friend Staples, and part of the reason for this is that Staples really is a cyclical company. It's pretty clear that it's, if you look at the bottom graph that Mark is showing here, that it really got whacked in the Great Recession, and it is slowly recovering. But the fact is that there has been a bit of a slowdown elsewhere in the world, certainly in Europe, not so much Australia, although Staples is hurting a little bit there, but there has been a slowdown, and Staples is going to suffer because of that. So it's probably both a leading indicator of a recession and a leading indicator of a recovery, but it is the best of a bad bunch in its space. And so my thought is that it's not going to go anywhere, and when things improve, Staples will certainly improve too. And I can tell you, 10 years ago, if I had looked at the SSG of Staples, I would have run screaming. But I guess in the last 4 or 5 years, I've got very interested in the financial equivalent of car crashes, because we've seen a lot of good companies get failed and then come bouncing back. And I've been benefiting greatly from such companies, and I hope to continue to do so. I know bottom fishing or special situations is a very dangerous place to be, but it's just that recently a lot of very good companies have found themselves at bottoms, and multi-year or even multi-decade bottoms, and they found themselves in special situations, bizarre situations. So it's been very tempting to go and look. And that's the reason really that the attraction to Staples, particularly because it's trading at lows and has been for some time. I think its 52-week high was 16 or 17, and it closed yesterday at $11.22, and its 52-week low is $10.57. So I personally, full disclosure here, have been accumulating Staples fairly regularly. It pays a reasonable dividend. The yield is 3 to 4%, that range. It's nothing to get hyper excited about, but the dividend has grown twice the rate of revenue, something that won't be sustained forever. But I do believe that this company particularly will benefit from a recovery when it happens. And I mean, I've said for a while that the recovery will be slow. I mean, I know technically we're in recovery phase right now, we're out of a recession, but it's not a super great recovery, and I don't anticipate it will be a great recovery until maybe another 2 or 3 years. So I'm using it as a buying opportunity for companies such as Staples and banks when they reach lows for the year.
And Hugh, we might use this company as an example of you know, we often talk about when you're looking at a retail company, number of stores can be a very important factor. And these guys really are, they're managing their portfolio. They're managing the stores that are actually in service. And you see that in that red shaded in area. And they're actually back to a point where they're going to begin adding total net number of stores over the next several years. So they actually are going through one of those, as Hugh said, special situations, and but one that you can really dig into and understand and see how the strategy deploys. So with that, we'll launch into your slides too, Hugh.
Yeah, they have been closing some underperforming stores and then opening up new ones. So a lot of this information came from the company website. It's a $25 billion a year company as measured by revenues, and it has pretty good EBIT, or EBITDA, the third line there, which is a proxy almost for free cash flow. Free cash flow is very close to EBITDA, so it's not a bad thing to look at. But things have been flat. I mean, it has not been growing aggressively, and the fact is that the company actually has been quite good at forecasting the problem that it's in. So in other words, it forecasted what it was going to happen in the third quarter a number of quarters ago, and it hit the mark pretty accurately. So it's a sign that it knows its business and it understands the environment in which it's operating. and it took a big hit in the third quarter as well, so earnings were negative. But if you exclude that, you know, you look at things from operations, it is where it should be, but we would like it to be somewhat better, but unfortunately it cannot escape the gravity, literally the gravity of the economic situation that it's in, where small business formation has slowed down and will eventually pick up, and that will be the lifeblood of a company like Staples. It has a relatively good dividend yield, by the way. You can see it's almost 4%, and it only started paying a dividend. It's certainly less than 10 years ago. I want to say 2004, 2005. I started buying this company in the 90s. I think I might actually be buying it cheaper today than I bought it in the 90s, but it did have some splits, so that's good. And there you see some data, some ratios, based either on trailing 12 months or on the most recent quarter. And I always give this caveat because I've been asked this question before. That number on the right for debt to equity is a percentage, so it's not carrying a lot of debt. Most of the right-hand side of the balance sheet is actually shareholder equity, and it manages its debt fairly well and has been paying down some debt recently. And you can see I talked about this earlier. Its 5-year annual dividend growth rate is close to 13%. Revenues growth rate is half of that. And the revenue growth rate really got whacked during the Great Recession, and it's continuing to trundle along. I mean, it's growing at 1 or 2% in the U.S. It's declining in Europe. So it's getting hurt in the areas where it was expanding. We'll see some numbers later where you can see that traffic in stores is decreasing, but the average purchase of those that are in stores, the figure is increasing. So fewer people are going in, but the people that are there are buying more. The recent price, well, it was $11.22 yesterday. It was $11.10 when I pulled this from the company website, and that's pretty close to its 52-week low. But you know, it could hit another 52-week low next year, 2013. I wouldn't be surprised if it dropped below $10.57. If there are expectations around inaction in Congress, people start to pull back, which could well happen. It will have an adverse effect on a company like Staples. And in the kind of backward world of NEIC/manifest investing type investing, I say that with joy in my heart, because for a long-term investor, you're able to buy a good company at a lower price. I focus on what I'm going to buy, not what's in the portfolio already. And the 52-week range is about $17, and as I just said a second ago, the low is $10.57, and it could get lower than that. So it's time to buckle up. And interestingly, the mean recommendation for this company is positive. From sell to strong buy, 2.5 would be in the middle. It was sitting at 2.4 the last time this company was visited, I think in August, here on the round table. The mean recommendation has improved to 2.8. I think if we slip to the next slide, we can see that the percent of institutions has dropped slightly in the last 6 months, the number of mutual funds that is, but it still has a large number of shares held by the people who are most likely to stampede but haven't done so yet. And then if we skip to the next slide, I think it shows the it's the institutional ownership again, and it gives some details. But let's skip to the next one. And there you can see the recent recommendations in the last month, the last 2 months, and the current month. And it's slightly above hold, 2.8. It would be 2.5 if the average were hold. It's not 2.8, and you can see that people are moving from underperform or hold in slightly into a buy or even higher. And I think this shows what people have been doing recently. UBS recently downgraded it, but Harrison Company gave it an upgrade. They just recently started to cover it. And JP Morgan back in January of 2010 gave it an upgrade. There hasn't been a lot of activity there recently. So the company sales in the last quarter was down 2% in the U.S., $6.4 billion. EPS is flat quarter to quarter, and that's a non-GAAP measure because it excludes a charge the company took for a bit of restructuring. Let me go find it. Screensaver came on there. Same-store sale, that is sales overall have declined in U.S. dollars. Sales in the U.S. are up very slightly, but the 1% is flat. And as I said, same-store sales are declining slightly. Customer traffic is down, but the average order is up. And Staples as a company is moving more from selling in stores to selling online. So one of the things you might worry about is there's something structural happening that could damage Staples long term. And obviously, if it didn't have an internet presence, it would be in an awful lot weaker position. But it has a very strong internet presence. And I bring back a slide that I showed about 6 months ago where you can see that Staples is the #2 electronic retailer behind Amazon. So we skip to the next slide. This is news for the US. The sales and computer sales have slowed down very, very strongly, and the expectation is that people aren't buying new computers because they know Windows 8 is being launched, and so they're postponing the sales until that happened. These numbers are for the third, not the fourth quarter, this discussion. This is the most recent, this is taken from the most recent discussion of management, and therefore the most recent discussion of the financial numbers that are available. Operating margin is up a little bit because the company has, as I said, it's restructuring itself in different areas, operating efficiency, and it's reducing its distribution costs as well. Ultimately, you can only restructure yourself so much to make your numbers look better. You have to improve the top line. And the top line, as I've said before, is not likely to improve until the economy improves. So in the meantime, I've said I'm accumulating Staples in anticipation of an improvement when things get better. Overseas, it's a mess. Sales are dropping dramatically, but you can see the problem exists in Europe. That's where the company is really suffering, and it's selling a subsidiary in Europe that handles printing services, etc. It's going to dump that entirely. Traffic is down a lot more than in Europe than in the US. Same-store sales are down significantly. I would say 6% is a significant number for a company like this. Even catalog sales have dropped. And it's not only in Europe, but it's in Australia as well. And Australia is doing well as an economy because it benefits from selling raw materials to China. That has slowed down a little bit recently, and maybe Staples is hurting because of that. But Staples doesn't have a huge footprint in Australia yet. And Australia is a small country. It's 30 million people. So it's not going to make a huge impact on the financials of Staples, even if the company were more widespread there. Europe is the place to watch, and Europe is the place where the company was expanding up until the point where the Great Recession started, and then that expansion has slowed down. So it's not the company's growth depends not only on the U.S., but big time in the U.S. because most stores are there, 1,900, but also in Europe. That's where it could have the most upside in the future. And the future is at least 5 years away. Just a heads up on that one. So we look at the next slide, which will be slide 24. Q3 was bad, but the company did hit its guidance. I pointed that out before. And there are many ways to show that the company is cheap. It has a very good debt-to-equity ratio, and it's selling at a low multiple of cash flow. And you can even look at shareholders' equity as a percent of the share price, and it's getting to the position where it might even be a value play. Not there yet. So we skip to the next slide. I've gone through this in the past before. The numbers have been revised. It has 2,200, 2,300 superstores. On average, they stock about 8,000 units, different items, SKUs. It invented the concept back in '86. It has almost 90,000 employees. 80% of its customers are business, 20% are consumers. It does a lot of delivery work, as you can see, and it did that because it bought some major competitors in that space, Quill.com, etc. And I jokingly said the last time, if you want Dunder Mifflin paper, for those of you who are a fan of The Office, you can actually buy it from one of Staples' subsidiaries. They bought the rights to Dunder Mifflin, and they sell Dunder Mifflin paper products. Dunder Mifflin doesn't exist, by the way. It's just an invention of Hollywood, but now it does exist, thanks to Staples. And I don't think it's Quill. I think it's its other subsidiary, but you can see the bulk of its stores, 1,900, are in North America, the U.S., and in Canada. It has a big chunk of company sales, and most of its business is in North America and Canada. And on the next slide, I think, is where it, well, that shows where it is internationally, but things are slowing down internationally, as we saw. And then finally, on the next slide, you can see that it is the #2 electronic retailer behind Amazon.com. I think that's important for the way things are moving. A lot lot of us are actually buying things and having them delivered by UPS or FedEx. Amazon is doing very well, certainly a company to keep looking at. But it is a major player in this space, and I think that's important because I would be very concerned about Staples' long-term viability if it weren't in this space. So we skip along to the next slide. I think it's when I look at its SSG, and probably should have enlarged this, but I think anyone looking at this immediately would certainly I would 10 years ago, have run screaming, because you can see revenues are decreasing, profit margins decreasing, its earnings took a hit in the last quarter for the first time, I think, in well over 10 years it's had negative earnings. But that's a situation where it did that deliberately. A restructuring charge was added in there. But this is a special situation. This is a company, as I keep saying, that is waiting for the economy to really recover and get back on track. And no one knows when that will be. I think it's going to be a little bit further than even the most optimistic analysts are saying. On the second part of the SSG, well, it's not as healthy as Mesa Labs, but it's not in good shape. And the ROE, which is the one I tend to look at most closely, is improving slightly. You could argue whether or not you should compare 2007 with what's been happened recently, and certainly when we get into 2012 numbers, and that 2007 gets pushed a little bit to the left, things might look better, but that's just a cosmetic effect. This has to be looked at quite seriously. I mean, its debt to equity is improving, which is good, but everything else is it's really still suffering from the Great Recession, hasn't fully recovered. And so I continue to look at the same PE ratios, 17, very optimistic, may not hit it next year, and 10 as the low PE, and we're kind of close to that at the moment. If you discounted that negative third quarter number and just looked at operations, the PE would be about 11 or 12, I believe. And then if we go to part 4 of the SSG, the upside-downside ratio is pretty high. And when I saw that 9-to-1 number, you go back immediately to see what's going on. And it's driven primarily by price. And by price, I mean the price is down. People's expectations of the future is pessimistic about this company. And I think in the short term, there's very good reason to be pessimistic as to whether or not Staples' share price will recover. The company will still continue to trundle along. It will continue its strong free cash flow, continue to pay its dividend, but it's going to take a little bit longer than 1 year for this company to recover. And I want to take advantage of that pessimism, because I think in the long term this company will do well. Its stock will double, maybe not exactly in 5 years, but it could. And I want to benefit from that, and I want to continue to buy it. So we skip to the next one, which I think looks at Manifest recently. We can see that its projected annual return is pretty anemic compared to other companies in the portfolio. It's under 12%. I'm maybe a bit longer term person here in my own defense, but the quality of the company is good. So let's skip to the next one. This is the final summary. I mean, things have been flat. The SSG is actually getting worse, but I don't think that's a cause for concern yet. I don't think there's something fundamentally bad happening to the company. Businesses will continue to form, and they'll start to increase. The formation rate will increase as the economy recovers. The company is suffering overseas and will continue to do so, but it is the best of a bad bunch. I don't think it's going anywhere. And just to re-echo, it will continue to suffer with the economy. But when things recover nicely, the company will too, and that's why I want to keep adding Staples to the portfolio.
All right. Well, thanks, Hugh. It certainly is an interesting situation. Ken, do we show any questions we want to tackle on Staples right now, or?
Unmuted.
Ken is unmuted.
Ken is unmuted.
Ken, are you still there? I got a little bit of an echo there, yeah. I think we may be having some weather-related difficulties here.
He's filling his coffee cup.
Could be. All right, I'm going to go ahead and press on. You can still hear me okay, right, Hugh?
Absolutely.
Okay.
Yeah, I can hear you. Can you hear me at all?
Yep, you're back now, Ken.
Absolutely.
You can. Okay. All right. Great.
All right. we'll save questions for later. I'll knock this out in a few minutes, and then we can wrap things up. If anybody has any questions about staples or observations, we can go forward. I do regard it as one of those special situations that makes a lot of sense to me based on what Hugh has painted. And all you got to do is go back to, in fact, I looked at the value line PE a minute ago, and that's actually at 8. And that includes 2 trailing quarters and 2 forward quarters. So, I mean, it's way down there from a PE perspective, and obviously from a low total return forecast perspective, too. So let's go ahead and turn the page and let me wrap up the stock selections for now by just basically doing a little bit of shopping. I know a lot of you guys are probably worn out. Maybe it is time to let somebody else do the shopping. And I just want to spend a moment talking about one place you might turn. If you're not aware of it, we did start a blog at Manifest Investing. It's expectingalpha.com. That's a screenshot of it that you see there. I would encourage you to go there and take a look. This is the type of thing you can share with family and friends. It's not meant to replace anything that we do. It's just meant to serve some pretty high-quality appetizers and hors d'oeuvres to the rest of the investing world and give us an opportunity to interface and collaborate with people outside the wall, so to speak, because we really are interested in expanding our what we do into a much wider community. I think everybody here believes that's an important thing to do. One example of that is Eddie Elfenbein at his blog is called crossingwallstreet.com. I would really encourage everybody here to take a look at his blog. It's free, and you see a little snippet of it there on the screen. And in fact, he answers that fiscal cliff question as well as anybody I've ever seen. He calls it a fiscal slope, not a cliff. But one of the other reasons that you might want to go there is I've been tracking this guy for a while now. In his selections that he makes at this time of year, he picks 20 stocks, leaves the 20 stocks in there for the entire calendar year, and he's outperformed the S&P 500 6 out of the last 7 years, in fact, 6 in a row. And anytime somebody does that, whether it's inside our community or outside, we tend to pay attention to that. You can actually go to Expecting Alpha or to crossingwallstreet.com, click on that link, and you'll actually see Eddie's stock picks along with some commentary. So I would encourage you to do that. The snapshot that you see here, just go to Expecting Alpha, and you can kind of kick around and see some of the stuff that we're trying to do. Here are Eddie's picks for 2013 stocks that he thinks will collectively outperform the broader stock market. And you can see there's a lot of very household names, community favorites on the list, along with a few of, I would call them Hugh McManus type stocks, special situations. You know, your Fords perhaps, some of the companies that have a little bit different color than we're used to in that quality column. That doesn't mean that they're bad ideas. They could be, again, a special situation with merit. You might want to dig in and see what Eddie has to say, particularly if you're an experienced investor. I mean, one that comes to mind for me is the ticker symbol CA, Computer Associates, the company. That's one that I'd really have to work at getting my arms around, and I really would want to hear what he has to say, dig in and do the type of study that we always do. But some outstanding companies on there. It was interesting as we watched Eddie add his final stocks to his list for this year. He picked companies that would have shown up right at the top of our screens 80 or 90% of the time. So again, my pitch is he thinks like us. He can help you watch stocks if you own them or if you're in a club situation where you're a stock watcher. So again, the link is there to watch that dashboard as the year goes by.
I think he added Microsoft, right?
I believe he did add Microsoft, absolutely. Yeah. So that's an example of somebody that sees perhaps undiscovered potential in a company like Microsoft. Again, one of those Acampora companies that has been stuck in the mud for years. We also put out a list, our Christmas countdown, which you can access through the Expecting Alpha or the Manifest forum. And here are the 12 stocks that I kicked out, including some special situations of my own. Some of you may question my special situation track record. It's not as good as Hugh's, but Cherokee, for example, would probably fit that bill. Do an SSG on Cherokee, you're probably not going to like it. But if you're an experienced investor and understand what they're doing with new brands, new partnerships, and in different parts of the globe, could make some sense. I like Mocon. That's another precision instrument company like Ken was talking about with Mesa earlier. It's a Charles Almond favorite, so you can read up on Charles Almond, the dancing bear. But again, these are just some fairly interesting ideas. Note that Mesa's on the list, as well as Coca-Cola, which is the one that I'm going to go forward with here for today's selection. The list that you see up at the top of the page here is just simply out of our database where I've gone in and I'm looking for companies that have, you know, relatively high projected annual return, hopefully not too high. We don't want to get nosebleed. Always want decent or high quality. And again, all of those are excellent. Some are a little less excellent, but all excellent. And I really wanted to focus in on companies that have a high manifest ranking. And again, the manifest rank is a combination of the return forecast, the projected annual return, combined with the quality rating. So the higher the better, and they're ranked from top to bottom. So I really like seeing these companies in here with the hundreds and the 99s. Basically, they are very fundamentally sound for the long term. All of those companies that you see there with the hashes. The next column over is, again, just kind of a timing thing. All of these companies score as good or exceptional, but I'm often looking for a company that's a little bit more on sale. So I'm looking for a company that might be punished a little bit lately, a little bit oversold. You might, as you hear people talk about it, so I'm looking for companies that are down in that 30 range when it comes to the relative strength index. And again, that's courtesy of stockcharts.com for all of these companies. You can look up all of these. And I'm just kind of zoning in on the ones that are down in that neighborhood of 30. So my attention is drawn to some of those in the middle of the list. I probably prefer, for what we're doing here today, to avoid some of them that are a little more bearish. So I'd be focused in on the bulls. And again, my attention is being drawn to some of these towards the middle here. The trend price objective is shown here, along with the amount of potential price appreciation. I think of this as upward or downward price pressure. And that's what you see up here at the top. So again, I want my company to have, you know, basically some wind in its sails. So I'm looking for companies that are bullish with a little bit of potential wind in their sails. So I want to see, you know, basically a sentiment kind of giving them that little bit of a push. And then last but not least, we kind of rank them all, combine all the factors, and that's what this list was formed of. Not just good fundamental factors, but also good technical factors. And then last but not least, for that strong second opinion, we bring the value line, low total return rating, and I'd like to see a little bit of confirmation there. Again, that is just one opinion. So sometimes the manifest numbers will be affected or altered by Standard & Poor's, Morningstar, the various things that we look at. And as I look over my entire list, again, I'm looking for a company with a decent return forecast, high quality rating that could possibly be on sale. My attention is drawn to, of all companies, Coca-Cola, a company that I do own and love. I know that you people that are joining us from Atlanta probably enjoy this selection. Santa obviously enjoys Coca-Cola. So that's going to be my selection, a little bit different than Mesa Labs, a little bit different than Staples. I'm settling for less here. But, you know, when you think that the average stock in the stock market right now is probably running at a return forecast of 8 to 9%, we're talking about buying Coca-Cola at, you know, at 11, 12%. That still is 3 to 4 percentage points better than the market. And one of the things I like to point out is, oh, bless you. One of the things I like to point out is several months ago we talked about how we were struggling to get back to a positive relative return, and Ken made the open declaration that he was going to stop messing around quite so much and make sure that we had enough core companies, you know, very blue chip companies, very high quality ratings, maybe aiming for a little bit less projected return or return forecast. And I think Coca-Cola probably fits that bill. Coca-Cola does not show up on lists like this very often. And we'll take a look at that as we dig into the company, but that's what I'm going to go with here. This is no stranger to anybody. It's probably, if not the most recognized and respected brand name in the world. It's right up there in the top 3. Again, value line, taking a look at the low total return forecast, confirms the results of my study, or at least aligns with it at that 10% level. You can see that Coca-Cola was impacted here by the Great Recession. You know, even the consumption of carbonated beverages and the various beverages that Coca-Cola produces can go down at during the pretty nasty recession that we went through back in that time frame. Now, keep in mind that these guys are not just brown-colored bubbly water. I mean, they do have Sprite, Fanta. They do make Powerade, Minute Maid, different kinds of water. So it's not just the traditional Coca-Cola, although that's what they're obviously pretty well known for. The other thing that you want to notice from this this illustration here is I have removed the years 2010 and before. Why would I do something crazy like that? Well, the reason is there was a step change acquisition here. This step change acquisition was they basically bought out Coca-Cola Enterprises and basically changed the entire business model for the company during the year 2010. So again, that kind of messes with the historical data a little bit because the Coca-Cola Enterprise numbers are not in any of these sales numbers, not included in any of those. So all we can do is take a look at the actual results for the combined enterprise for 2011 and the 2012 and 2013 forecast. Obviously, within a few weeks, we'll have an actual number here for this one. But again, it's a transformed company growing, again, respectably in that 5%, probably 5 to 6% growth range, not 10% that you would get if you left these years in. Okay? Again, transformed company, so you want to pay a little bit less attention to the numbers on the left, pay more attention to the numbers on the right, including the actual number for 2011 when it comes to profitability and the expectations for 2012 and 2013. So again, don't look for 25% net margins from the company, but 18, 19, 20% would make a lot of sense to me. Here's a quick look at the equity analysis guide that you can get to from the My Worksheets section or my stock study library, and just kind of running through the numbers. This is a $48 billion company growing at 5% or so with a net margin in that 20% range. So again, 5% growth, 20% margins. You could assume 19 and you'd be certainly well within the realm of reasonability. $3 earnings per share 5 years out with an earnings with a PE ratio of about 18. So we're looking for a stock price somewhere in the mid-50s. And from where it is today, we're looking at, again, 11 to 12% projected annual return. So again, that just kind of gives you a quick side-by-side of where it is today. We're looking for a little bit of margin expansion here from the mid-17s to up to the 20, looking for a fairly stable PE ratio. And pretty good company overall. Again, we don't expect quite as much from it, but we like it a lot. Here's a look at the chronicle for the company with the price removed because, again, a lot of times we get distracted by looking back at the price. I've just taken it out of this. And we want to focus on the return forecasts. Anytime we're studying stocks, pay less attention to the stock price, pay more attention to the return forecast. So that's what we're showing you here. Obviously, very high-quality company forever. Very high-quality company, so we can just take that as a given. The projected annual return, again, back during, he was talking about this earlier, back during the depths of the Great Recession, Coca-Cola was more on sale or more undervalued than it's been in a very, very long time. Very elevated returns. So taking that out of the picture, taking a look at today's projected annual return somewhere in that 11 to 12% range, again, it doesn't get that high very often, as you can see at this chart. So it's up in levels that it doesn't seem to get to all that often, but something that we might have to embrace when it comes to a higher quality company like Coca-Cola. This last slide down, graphic down here at the bottom is the projected relative return, the projected relative return for Coca-Cola versus the general stock market. And what we're basically looking for here is anytime it is above 0, but not too high. So we're basically looking for it to be in the sweet spot. So anytime you look at a chronicle at Manifest Investing and you're looking at this display, anytime you're in this range, this 0 to 5% range, you're in an outperform the general stock market mode. So this period was obviously quite good, not too frothy, and we're back into one of those periods when it doesn't look too bad, projected to outperform the market. So it's a generally attractive situation for Coca-Cola and one that we'll pay attention to. Just as a quick reminder, we do keep the tracking portfolio for the portfolio, the dashboard for the roundtable online, so you can access that at any time going to the Manifest Investing site, or you can send a note to either Ken or myself. We'd be happy to take you to that. So with that, we're going to go ahead with our selections of Mesa Labs, Staples, and Coca-Cola for our December meeting and hope for the best from them. Any questions or comments?
Mark, we have a couple of questions that we're going to handle after the official close of the webcast.
Okay.
But I would like to get the poll out there if we could, if you give me just a moment here.
Okay, go ahead and crank that up. And, you know, unlike Santa Claus, we don't keep a list of who's naughty and nice as you vote for our 3 selections. At least that's what we tell you.
I always get a kick out of Coke.
I got it correct today. All right.
Wow.
Awesome. So you basically have a pretty good collection, from special situation to emerging, promising young company to basically blue chip stalwart that isn't dramatically on sale, but probably considered to be on sale by most who follow it.
All we're asking you to do, folks, is take your mouse and press one of the buttons next to one of the names right there.
Okay.
We're up to about 85% voting. Let's see if we can push that to 90%.
I would like to disclaim on behalf of my partner, Hugh, that Ken has an unfair advantage due to the January effect right here. It's a good time to go shopping for small companies, and most of you here know that.
And
I
Mark,
thought you were talking about the upcoming national championship.
I'm going to close the poll, and I'm going to share the results. And you can see that 80% of our folks that were voting have chosen to add Mesa Labs to the portfolio. 17% have chosen to add Coke. And Hugh, they're just not sold on staples right now. So
that's not my vote.
You're going to win.
Did you see what I wrote in the
okay?
comment box? Did you see what I wrote in the comment box, Ken? When you open the polls?
Oh, I didn't catch it because I was working on the polls here. No.
I said Mesa will win by a wide margin.
Oh, all right.
Yeah, it's a very good-looking company.
Let's hide this. And Mark, we're ready to wrap it up, and then we'll take a few questions afterwards.
Okay, well, let's go ahead and we'll go ahead and put the fireplace back up, see if anybody has any questions or comments about today.
We'd like to thank all of you for coming today. I frankly thought we'd be down around 40 or 50 folks attending, and we were well into the high 80s for attendees, so thank you for showing up. Mark, we're getting a number of questions about price pressure. You have that on your chart. Can you define what that means a little bit and how you calculate it?
Sure. Let me go ahead and take a look at it, jump to where it's shown so everybody knows what we're talking about. That's not quite it. Bear with me while I navigate here. I grabbed Hugh's colorful slide instead of mine. Okay, so they're asking about this price pressure slide. And basically what we're looking at here is something that we don't often talk about. So again, you don't need this. Let me underscore that and be crystal about that. You don't need this. I mean, if we're talking about probably 90% of the companies on this list are fine over the long term, and you want to always keep that in mind. But sometimes it makes sense to see who's got that, as I said before, wind in their sails. So what I'm looking at here is, and there's a lot of places out there that track sentiment. In fact, Hugh used one when he talked about staples, when he was looking at the analyst buy, sell, and hold recommendations. Those are good, but when I think of the world of technical analysis, I kind of look at it from the perspective of not just what are they saying, not what are they touting or talking about when they're a talking head on CNBC, but technical analysis actually looks at the volume and price activity. What are they actually doing out there? And what do I mean by that? I'm going to jump out and go to stockcharts.com and show where one of those would come from. And what I'm going to do is go to Coca-Cola at stockcharts.com. Again, this is free. And one of the things that we look at is, in the case of Coca-Cola, here's the relative strength index, which means it's down here at these levels. And again, kind of think of it, you can either think of it as Marianne Davis says, snow on the mountain is up here, be careful, don't add to it when it's up here. Or in my case, I kind of like to think of it as a stoplight where the green light is down here at 30 and the red light's up here at 70. And in this case, Coca-Cola is down closer to the land of the green light. So relative strength looks pretty good. Again, long-term trend, Very powerful. You can see that it's been in a bit of a downward slide for a while. Now, where does the price pressure come from? And again, this, if you want to learn more about this, you can go to the chart school here on stockcharts.com, and there's probably one other source that many of you never think about. If you go into the betterinvesting.org archives, you can search for columns by Len Reeser if you want to learn more about point and figure charting. He actually wrote a column in Better Investing magazine for over 2 decades about point and figure. Now, point and figure, I still don't get it, but a lot of people do. And they use it and they're influenced by it. A lot of the professional analysts and the rhinos on Wall Street, what we're looking at here is they take a look at Coca-Cola using this gizmo known as a point and figure chart. It has no time dimension to it. It's weird stuff. You have to dig in and understand it's actually very, very simple once you dig in and understand what's going on here. But the people who do this will use the patterns on this chart to keep track of what people are actually doing, you know, what decisions are actually being made these days. And based on that trend, you know, where might this company go? So again, Coca-Cola right now in the mid to high 30s, they see sometime in the perhaps not too distant future a bullish price objective. The company's got a bullish trend in place going up to 47.5%. So all I'm literally doing there is I'm looking for companies that fit that description, bullish where the expectation of a future price, this price objective of 47.5 is in place for those companies. So if we switch back to the slide here, you can see that under Coca-Cola, this 47.5 is the number. So I'm really just looking at the present price. How does that compare to the 47.50? So in other words, there's a positive price pressure of 30% in the case of Coca-Cola. You know, who is somebody else that has perhaps even more price pressure right now? Infosys Technology. The rhinos that follow this company are kind of falling back in love with it. It's been bearish for a while, and it seems to perhaps be inflecting back. So again, you can go company to company, sample a few of them, see what you think, perhaps track a few of them over time. I do think it has a little bit of merit, especially with respect to just this notion of entry and exit positions for transactions in stocks. So hopefully that helps you see where that comes from. You can go right down that list, see where that number comes from. And again, that's why, you know, perhaps like in a company like Teva, I love the company. I had picked it for the countdown. I wouldn't be the least bit surprised to see Teva continue to be stuck in the mud for a while, because it just doesn't have the same kind of wind in its sails. So hopefully that helps.
Mark, we have a couple of folks that would like to know, do we post the recordings of these sessions anywhere? And if so, where could they find them?
Yes, we will. We'll put the recording of this session up. You can look at any time under manifestinvesting.com/events. Let me show you where that's at so you can actually go to it. If you go to Manifest Investing, you don't even have to join Manifest Investing. Don't have to be a subscriber. If you just go to /events, you can actually go into past events, or recorded events. Click on recorded events, and then you'll see a number of past roundtables and then a variety of other subjects on things like screening, a variety of things. We did a real nice session on dashboard diagnostics there. We will be putting up the diligence presentation here fairly soon, so you can get to some past events there. You might also try searching on YouTube if you can't get to Manifest for some reason. And again, if you ever need help, send a note to either myself or Ken. His name's right on the cover slide.
Okay, Roger would like to know, what do I think of the PERT A graph for Mesa Labs? Mark, could you throw the screen to me? I'm trying to handle too many things at once here.
I'll see what I can do here. Hold on. Coming your way, Ken.
Okay, and I think that right now you should be seeing the PERT A screen for Mesa Labs, and I'm sure Roger's speaking about this long downward trend in sales, as well as the downward trend in earnings and pre-tax profits. And you know, if the zero line were sitting around here where my cursor is moving, I'd be quite concerned about this company. But I have to take into account the scale of this graph before I really have a lot of concerns. I noticed, for example, that in the last couple of quarters, the and this is trailing 4 quarters, not quarterly. I noticed that it's kind of leveled off now, but it's leveled off at an extremely high number at around 22%. The same thing is true here. They've moved a little bit below my expectation lines on my SSG, but they're still in the high teens. And until these lines move into the low teens, I'm not going to be especially worried about them. I know that these very small companies typically exhibit this frenetic up and down pattern that I'm seeing here. They don't start to even out until they get to be a little bit larger, and I'm looking for growth to level out somewhere in the 15, 16, 17, 18% area. That's still an extremely robust growth. So frankly, this PERT graph's not giving me any issues at the moment. Let's get another question out here if we can, because we have a whole bunch of them. Let me see if I can come up with another one here.
I do see Nancy Bethea has asked about, I see where Mark got the price objective. Still don't know what he's talking about with price pressure. Does it mean 32% above the current price? Yes, Nancy, it does. It's literally a comparison of that price target or price objective versus the current price.
Mark, Jane Johnson would like to know, could you elaborate just a little bit on the January effect? What did you mean by that?
Sure. What the January effect refers to, and it's probably even amplified or aggravated this year, every year come October or November, George Nicholson would write a column for Better Investing magazine where he talked about year-end tax-related selling. And it's most prominent because the smaller companies are going to be most affected. If people are dumping, think about the example perhaps of Equality Systems, where a number of us might be taking tax-related benefits by selling that position, even if we still believed in the company and wanted to buy it back in a couple of months. Well, a bunch of people doing that in combination can drive down the price of the smaller companies. So the January effect refers to the tax-related selling that presents buying opportunities most commonly manifested in smaller companies in the fourth quarter and early in the first quarter of the coming year. So again, Nicholson would always remind us at the end of the year and the beginning of the next year to be particularly vigilant about watching for opportunities in smaller companies because their prices would be affected by, again, people taking advantage of tax laws. And
I want to add that the January effect might be a little bit messed up this year because of folks selling winners to avoid higher capital gains taxes next year.
Absolutely.
I've heard that happening in quite a number of clubs where they're actually selling winners knowing that they're going to take the capital gains tax, but knowing that it's going to be lower this year than it will be next year. So there might be a little bit of disruption in that effect this particular year.
Yeah,
Julie, go on.
I was just going to say, I would encourage you to go to the search button on Manifest Investing, search January effect, and you can find some references. You could also go to Investopedia.com and search on January effect, and again, get a little bit of bolstering to that concept and answer.
Julie Werner would like to know how my club found Mesa Labs in the first place. Julie, when we're looking at, it starts off by screening, and we do use Manifest. Our whole model club is a member of the Manifest site, and it starts by doing some just screening for high-quality stocks there. But as we screen and look at different particular companies, off to the side on the Manifest screen, you always see a list of the best stocks in that particular industry or that sector. And one of our members noticed that this Mesa Labs kept popping up time and time and time again. She brought it to the club, and about a week and a half later, Mark featured it as his best stock to take a look at for the month. I think it was the month of November, wasn't it, Mark?
That's correct.
Yeah, so it just kept popping up, and we were drawn to it as the more we studied. Mark, Rebecca would like to know where she could find last month's roundtable. That's the one she's looking for, and it's not in the events section. Does that just mean Kurt hasn't got a chance to post it yet?
Yeah, we have archived recordings of all of them, and we just haven't either gotten to it or it required a little bit more editing. It'll be up eventually, and then we'll post a note out where people will catch it.
Ernie wants to know if you can invite more people to this webinar, and the answer is absolutely yes. Just forward them the link to the registration for the webinar. It's absolutely free. You can forward that link to as many people as you want to forward it to. And if you're not getting a reminder, send me an email, and I'll make sure you get on the reminder list. Each time Natalie puts a link up for the new roundtable, you'll get a reminder in your email that the link is now up. Anne would like to know what is the time frame for this bullish price objective on the point and figure charts? Do we know what the time frame is, Mark?
Nope. That's one of the really weird things about point and figure. It's dimensionless when it comes to time.
Okay, and Lynn would like to know, have either of us changed our opinion on QSII? He really used to like that stock. Big notice, so did I. I really think that the company has taken a huge misstep by the way it handled all of the issues with its board of directors and its proxy vote. On top of that, until we get some clarification on how much the government is going to continue to insist on these digital records for the doctors and the dentists and everything, I think I'm going to stay away from this stock. Once there's some clarification on whether or not that money is going to continue to flow to these companies and whether we're going to continue to ask doctors to move towards digital records, then I think we'll have some clarity as to how strong Quality Systems is as a player in the whole field. I did note about 3 months ago on the roundtable here that I feel that a lot of the competition that's been recent with Quality Systems is coming from some extremely established companies, and that makes me quite nervous when I'm talking about a small, relatively newcomer like Quality Systems.
Yeah, and I would just point out, Ken, if you go to just do a search on Quality Systems, there's a very extensive discussion of the, I'll call it a six-ring circus going on at the company, and yeah, we're not real happy with what we see happening. The company appears to be challenged to focus on doing its business, and I think that's probably the best way to characterize it. I think it has a lot of potential, but for instance, that's from just a few months ago. That picture is dramatically different today.
Yeah, and the pressure right now of people selling this stock to reap a capital loss, I think, is huge. Now that obviously will be all finished by next Wednesday, but or at least the huge pressure to sell it. But I think there are a lot of people getting rid of this in the portfolio, even if they do have some faith in the company. Mark, I think we've cleared up most of the immediate questions, and I don't see any hands raised. We'd like to thank everybody for spending an hour and a half with us today in the heart of the holidays and everything. Wish you all a Happy New Year, a special Happy New Year to Hugh and to Mark. And thank you both, gentlemen, for being with us today. Mark, any last comments?
No, other than say thanks, everybody. Happy New Year. Be safe. And if you find any can't miss stock opportunities, share with all your friends.